Hello everybody, this is AK. I'm back. So if you have been following my videos, you know that I warn against such titles that you see on screen now. Buy for 9% dividend yield before it's gone. Yeah, so when we invest in stocks and REITs, right, it's not just about the yield, right? We're not putting money in a fixed deposit. We're not buying T-bills, that kind of thing, right? So it's a lot more than just yield, right? And today we talk about OUE Commercial Real Estate Investment Trust. I do not have a stake in this REIT. I don't plan on having a stake in this REIT, right? That's the TLDR in case you don't want to watch anymore. You just want to know whether AK is buying. Okay. In my last video on Capital Infrastructure Trust, towards the end, I said something about this REIT, and I said something about LiPo, and I said something about how by association I would avoid it, that kind of thing, right? So just to flesh it out in this video, if you are interested, you stick around, I'll tell you, right? Some, human beings have very short memories, right? And the advantage of having a blog is that I archive many events since 2009 and also my thoughts regarding these events, right? And from time to time, I will go back and revisit these blog posts and refresh my memory. And some memories are so poignant that I would not touch an investment with a 5-foot pole, even today. Right, and OUE Commercial Trust is actually a merger of two trusts, right? OUE Hospitality Trust and OUE REIT, right? And of course, both of them are from the Riyadi LiPo angle, and if we think of the Riyadi and LiPo angle, then we think of LiPo Mall Trust and we think of First REIT, and we look at what happened to them and where they are now, and pity the shareholders who are still holding on. Okay, maybe we can say that OUE Commercial Trust is a branch of the same tree, but it's a healthy branch, right? Same but different, right? And but if we look at the stock price, Mr. Market thinks otherwise now. Back in 2019, it was as high as 56.5 cents, and now it's 23 cents after touching a low of I think 20 cents recently. But of course, Mr. Market could be overly pessimistic. But if we ignore history, we're ignoring a vital part of the puzzle, I think, right? So if we just look at OUE Hospitality Trust, okay, which is like half of the current day REIT. Back in 2013, it had a distribution yield of some 7.5%, which looked pretty decent, right? And its gearing level was only 33%, which also looked pretty decent, right? But when we look at the kind of assets that they were holding, right, it had two properties, right? And the properties have about 44 years left to their leases. So we fast forward till today, that was in 2013, right? So 10 years later, those properties only have 34 years left to their leases. So we're talking like, Mandarin Hotel on Orchard Road, if I'm not mistaken, right? The leases are very short. So I've said before, if leases are very short, then distribution yields ought to be higher to compensate for a very short lease, right? If you have a very long lease, then you can afford to say accept lower distribution yield, because you have many more years to recover, right? But if the leases are very short, then your distribution yield has to be much higher because you don't have much time to recover your capital, right? So then if you look at OUE REIT, right, which had its IPO, I think in 2014, and I blogged about this in 2017. I said the IPO price of 80 cents was too high, right, for the kind of distribution yield that it was offering. And I also didn't like the fact that it had to provide income support in order to make the REIT to look more attractive than it was. Right? It's financial engineering. I never like things like this because basically they're just trying to make the investment look more attractive than it actually is. Right? And a few years later, OUE C-REIT actually had to do share placements at 20% lower than its IPO price to show up its balance sheet, because it started out with very high gearing of about 40%, if I'm not mistaken, 40 or 41%, right? And without the income support that the sponsor was giving, the REIT would definitely have had a much lower yield. And on the back of very high gearing, forget it, I wasn't going to touch it, and I didn't touch it, right? And but the OUE stable of REITs seem to have a liking for providing income support to make their investments, to make the REITs look more attractive to investors, right? We saw that happening with when they bought the hotel at Changi Airport. Was it called Crown Hotel or something, which wasn't mature yet, right? The income wasn't stable yet, and they just chuck it into the REIT and provided income support. And that's the same thing they did with OUE Downtown. They provided income support when they chuck it into the REIT. It's like they were trying to monetize all these assets by just dumping them onto their REIT investors, right? And when those income support expire, then you have an issue, because then the income, this distributable income would drop, right? And when you have that coupled with a high interest rate environment, a weak balance sheet, you have a cocktail of disaster, right? And so if you look at OUE commercial REIT today, right, and it's all playing out. It's all playing out, right? The income support that they provided for OUE Downtown has reduced. Because over time they say we'll provide less and less income support. The sponsor cannot keep giving high income support, right? So it's only in the initial phase that they provide high income support to make it look more attractive, right? And then, of course, I say coupled with high interest rates. Interest rates are very high now. It's been going up for more than a year. And the problem is that OUE's commercial REITs management has not been wise enough to have a lot more of their debt on fixed rate, right? The fact that only 68% of its loans are on fixed rate, and that the cost of debt has been going up, and now it's about 4.1%. Their finance cost has gone up a lot. So there's no surprise that the DPU plunged, I think, almost 30%. Right, the DPU plunged almost 30%, and we don't know how long this is going to last, especially if we believe in the narrative that interest rates are going to be higher for longer. Of course, this brings back some memories of what I just said about Lendlease and Suntec REIT, because they also have a big portion of their debt on floating rates. And if interest rates stay higher for longer, they will suffer as well, right? So I don't think, you remember saying about leopards and their spots, right? And I don't think the culture will change. It might change, who knows? But there are plenty of other investments out there. I don't want to die by OUE commercial REIT. Okay, so if AK can talk to himself, so can you. Bye bye.